Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Life and health insurance is the largest single segment of African insurance, accounting for approximately 55% of total premium. It encompasses traditional life insurance, funeral cover, retirement annuities, credit life, and health insurance products. In a continent with rapidly growing middle classes, expanding healthcare costs, and rising awareness of financial planning, life and health insurance offers some of the most attractive structural growth characteristics in African financial services. This presentation examines the life and health insurance landscape, focusing on the multi-billion-dollar institutions that anchor it and the structural forces that will determine its trajectory over the coming decade. The African life and health insurance segment generates approximately $50 billion in annual premium, representing 55% of total African insurance premium. Per capita premium is approximately $38, well below the global average of more than $500. More than 350 licensed life insurers operate across the continent, with significant fragmentation in markets like Nigeria, Kenya, and Egypt. South Africa accounts for approximately 70% of total African life and health premium, with the remaining 53 markets sharing the balance. This concentration creates both opportunity and challenge for Pan-African insurers seeking scale outside South Africa. The leading life and health insurers are concentrated in South Africa. Sanlam leads with a $10 billion market capitalization, followed by Old Mutual at $7 billion, Discovery at $6 billion, and Momentum Metropolitan at $2 billion. Liberty Holdings, now a subsidiary of Standard Bank, adds $1.5 billion. Outside South Africa, Wafa Insurance of Morocco, Brightwell Insurance of Nigeria, and Britam Life of Kenya anchor their respective markets. Together, these 8 firms capture a significant share of total African life and health premium, with the remainder distributed across hundreds of smaller national insurers. Discovery Limited, founded in 1992 by Adrian Gore, has pioneered behavioral insurance through its Vitality program. Vitality rewards policyholders for healthy behaviors, including exercise, healthy eating, and preventive health screenings, with premium discounts and other benefits. The program has been shown to materially improve health outcomes and reduce claims costs, creating a virtuous cycle of better health and lower insurance costs. Discovery has licensed Vitality to insurers in the United Kingdom, the United States, China, and other markets, generating significant fee income. The Discovery model is one of the most successful insurance innovations of the past 3 decades and is increasingly being adopted by other African insurers. The African Life and Health product suite includes 5 core categories: traditional life insurance, whole life, term life, and endowment policies providing death benefit protection and savings accumulation, sold primarily to middle and upper income customers. Funeral cover, a uniquely African product providing affordable coverage for end-of-life expenses, sold through funeral parlors, employers, and mobile money platforms. Retirement annuities, long-term savings products providing income in retirement, with significant tax advantages in South Africa and growing popularity in other markets. Credit life, insurance covering loan repayments in the event of death, disability, or retrenchment, typically sold alongside bank loans. And health insurance, private health insurance covering medical expenses, hospitalization, and preventive care, growing rapidly as public health systems strain under population growth. Health insurance is the growth frontier of African life and health insurance. The category is driven by expanding middle class, rising healthcare costs, and strain on public health systems. Discovery Health, Liberty Health, and Momentum Health dominate the South African market. Health insurance schemes in Kenya, Nigeria, and Egypt are growing rapidly, supported by national health insurance reforms. Challenges include adverse selection risk, fraud, rising medical inflation, and the need for sophisticated claims management infrastructure. Single-payer national health insurance initiatives, like Nigeria's ongoing NHIA reforms, could disrupt private health insurance markets if implemented comprehensively. Insurers that build scale, technology infrastructure, and provider networks will capture disproportionate growth in this category. South Africa accounts for approximately 70% of African life and health insurance premium, reflecting the depth of the South African insurance market, the maturity of its pension system, and the sophistication of its product offerings. Sanlam, Old Mutual, Discovery, Momentum Metropolitan, and Liberty dominate the South African market and have used it as a base for Pan-African expansion. Sanlam in particular has built a significant Pan-African footprint through acquisitions and joint ventures in more than 30 African countries. The South African dominance is both an advantage, providing scale and expertise for export, and a vulnerability, concentrating risk in a single market with its own macroeconomic challenges. Life insurers invest premium income to meet future claims through 5 key considerations. Long-duration liabilities. Life insurance liabilities are long-duration, requiring matching investment in long-duration assets like government bonds and infrastructure equity. Regulatory capital requirements. Solvency frameworks like solvency assessment and management in South Africa require life insurers to hold significant capital against insurance and market risks. Asset allocation. Typical allocation is 50 to 60% government bonds, 15 to 25% equities, 10 to 15% corporate bonds, and 5 to 10% property and alternatives. Sovereign exposure. Significant sovereign bond holdings create a sovereign insurer nexus similar to the sovereign bank nexus. And embedded value reporting. Combining net asset value with the present value of future profits from in-force policies is increasingly standard for major life insurers. In the 2023 financial year, leading African life insurers delivered an average return on equity of 13.5%, with Discovery leading at approximately 20% due to its behavioral insurance model and international expansion. Cost-to-income ratios were a median 18%, reflecting the operating leverage of long-duration life insurance. Solvency capital ratios averaged 2.1 times the regulatory requirement, providing significant buffer against market and insurance shocks. Embedded value, the key value metric for life insurers, grew at a 4 to 6% compound annual rate over the past 5 years, supported by new business growth and stable investment returns. In summary, life and health insurance premiums will grow at high single-digit rates over the next decade, with health insurance leading. Behavioral insurance models, pioneered by Discovery, will be increasingly adopted across the African life insurance industry. Mobile microinsurance will extend coverage to previously uneconomic customer segments, particularly for funeral and credit life products. And national health insurance reforms will reshape private health insurance markets, with both opportunities and risks for incumbent insurers. The life and health insurance subsegment offers attractive structural growth combined with disciplined capital management. Thank you for watching this examination of life and health insurance.